obviously, you and I have been concerned about debt levels globally and at the sovereign household and corporate level for years. Those are going to explode. And that starts with this huge historic package out of Washington, which will be legislated later today. I think it's a necessary evil in the short term. The U.S. economy and economies around the world are grinding to a screeching halt, and we've got to put a cushion underneath that process. If not, we're going to suffer even worse economic calamity.
Tim, good morning. It's Steve. And again, the three of us have talked about this for the best part of a decade as well. I was very interested in your language there. It's a necessary evil in the short term. The problem is, Tim, you know better than anyone, and you put out this fantastic monthly report and debt monitor as well, that it isn't short term. After the great financial crisis, nobody repaired their debt load. In fact, many countries got even worse in the intervening 10, 11 years as well. They're not going to get these debt levels down again after this crisis has passed, are they, Tim?
They're not, Steve, and you're absolutely right. Our next debt monitor report will be out in a couple of weeks, the first week of April. No, I think we're with this for a very long period of time. And, the next set of political leaders that have to take this on have an enormous historic challenge ahead of them, much like the leadership after World War II. And, of course, central bank balance sheets are going to hold a lot of this debt. So much of it may be monetized over time. But you're right, this is a historic shift in debt levels, not only in the U.S. and Europe, but also globally.
Well, Tim, share with us some thoughts on how we discriminate between the good actors and the bad actors in this, because I think we all understand, like Bagehot of old, when you have a crisis that requires liquidity, you turn on the taps and you address the immediate crisis. But we're not hearing any qualifications around how long this money will be available or when we might begin to see the Fed take back these emergency interest rate cuts. We're also not getting much clarification at this point as to how the distribution of this cash to corporates will discriminate around those that are in sectors that are clearly critical to dealing with this pandemic. Should we not be hearing more that implies or suggests that authorities actually understand the risks of just dropping cash into the economy and the financial system willy-nilly without understanding the consequences?
Sure, Jeff, it is a great risk. Built into this legislation is a sufficient amount of oversight, legislative oversight of the executive branch's decision-making about how they allocate these resources. The airline industry, for one, which is obviously critical infrastructure, and an industry which has been decimated in this crisis, will receive a pretty large amount of support. And the rest of the money, about $500 billion flowing to corporate America, will flow to those industries that are most damaged: the restaurant industry, the entertainment industry, the shipping industry. And those industries have really ground to a halt.
Hi, I'm Joanna Bersecci, and thank you for watching. You can check out more of our videos by clicking on the boxes on the screen. And don't forget to subscribe to our channel for more from CNBC International. Thank you for watching.